So our topics we're going to talk about, the important ones, employer responsibilities. There are some things that you might think you only need to do in year one, but they're going to be continuing responsibilities for you as the employer. The other most important, I think, is CalPERS. CalPERS has changed the way that they're providing the information to you today, or this year. And just to point out, during this presentation, my focus is going to primarily be on CalPERS, but of course, if you have any single employer or other entity questions, we can try to work through those as well, but CalPERS is the primary provider of this information. Then we'll talk about some items that are specific to cost-sharing plans, deferred inflows and outflows, and some other little reminders. So, getting into employer responsibilities. So every year of implementing or reporting under GASB Statements 68 and 71, whether you're an agent employer or a part of a cost-sharing pool, there are certain items that you're responsible for as the employer. And where these responsibilities come from our perspective, is through the AICPA's State and Local Government Expert Panel, oh my goodness, SLGEP. They issued white papers, and then as well, they then incorporated the information into the AICPA audit guide. And those responsibilities include you're responsible for the census data. Even when you participate in a CalPERS plan or an agent or a cost-sharing plan, you're responsible for your portion of the census data. For the agent plans, you're responsible for verifying the completeness and accuracy of that information. Now, CalPERS has taken it a step, and they have their auditors perform audit procedures for the retirees, and they issue an audit opinion related to the census data for retirees, but not for the active participants. So you're still responsible for making sure that your information for active employees is accurate, reasonably, fairly stated. And how you get that information is you request the census data report from CalPERS, but of course when they provide it to you, it includes everybody. It includes actives, inactives, terminated, and your retirees. So you have to find out, there's ways to they have a cheat sheet that they issued that has the titles, because when you get that census data report, it has numbers for the headings, which hopefully all of you in agent plans aren't unfamiliar with it, since you did it last year, right? You already did what you needed to do with that report. And so then it interprets it, tells you what the columns are. You can sort that report for actives and then just look at the active data in that census data. So that's something you need to do every single year, because that every year PERS is taking that year's census information, and that's what was used to prepare the actuarial valuation. Now remember, there are two differences. There's the actuarial valuation and the accounting valuation. Actuarial is the one that they produce to provide your funding information every year, and it's always 2 years, 3 years prior for the current year contribution rates. That's why the census data that they provide you is going to be old census data, but you still have to compare it to your information for that particular year's records. The other part that you're responsible for is the financial statements, establishing a financial reporting process and controls over the measurement of your specific pension amounts. You're responsible for that. So even though PERS is providing you the inputs, you are putting them into your financial statements, so you have to make sure that you agree with the information and are presenting it correctly. And finally, the actuarial assumptions. You need to support, the assumptions need to be supportable and supported when you're in an agent plan. Again, you're relying upon the information from CalPERS. If for some reason you don't agree with the actuarial assumptions that CalPERS is using, then you would need to go out and get your own actuary if you didn't agree with them. So you want to make sure that you're assessing that information each year. And of course, if you were to have a standalone plan, you're usually the one selecting the actuarial assumptions, so they need to be reasonable and you need to agree with them or not. Well, why would you select them if you didn't agree with them? But you know what I mean. Okay, so for the cost-sharing plans, the employer responsibilities, a little smaller list, because the plan itself will issue financial statements that provide the information that you can rely on, hopefully, if they that have auditor opinions. So you're responsible for evaluating the information used to recognize and disclose pension amounts in your financial statements. You have to understand what you are reading and making sure it can't be, the financial statements are your financial statements, it's not for the auditors to interpret, so that's why you have to know what numbers go where and how you get the information in the general ledger and provide the right information. That's going to become more important this year since CalPERS has changed the way that it's providing you with the information. Then you may use the plan auditor's report on the plan's schedules. What does that mean? There are two schedules that the plan's auditors can opine on or provide an opinion on, and those are the schedule of employer allocations, or those are the percentages that you use to calculate your share of the pool as a whole, and the other is collective pension amounts. The plan in total, they're going to issue an opinion on the collective or the grand total of the pension amounts spread out or allocated by participant. And so those two, that's why then you're able to take those reports and use them to provide the information for your own financial statements. Okay. So again, for this, if you're a single employer, if you happen to have a single employer plan, you're responsible for a little bit more because you are the entity, you are the employer for that plan. So you're responsible not only for the census data, the actuarial assumptions, and for establishing financial reporting for the pension amounts that are going to be included in your financial statements, then you're also responsible for evaluating the information used to recognize and disclose pension amounts in your financial statements. You're responsible for everything. Okay. So CalPERS this year. CalPERS changed. For those of you that may or may not have noticed, they made some changes this year. For the agent plans, they're still issuing one accounting valuation for each agent plan. But for the cost-sharing plans, they are not. They are issuing one report for each risk pool in total, and then another report that gives you the percentages or the information you need to determine, calculate and determine your own amounts for the share of that pool. So it's a big difference. So that's why for the agent plans, you're still required to go into MyCalPERS and order your report and request your census data information. But for the cost-sharing plans, because they're issuing that one report that anybody could go on the website and get, they're billing you for each of your plans. I don't know if you've all noticed that. You got a bill. It was a little bit lower this year, which was a good thing, but you didn't get an option, because if they were to put the reports out there and only bill one entity, anybody could go get it. Okay. So that was their workaround. So the footnote disclosures for the agent plans, that's one difference here. For the footnote disclosures, last year everything was in each individual agent report. Now they have the agent plan that has the dollars that are specific to your agent plan, but then any footnote disclosures that are boilerplate or used in for every report, that's in a separate report that's available on their website, and it's called the Notes to the Agent Multiple Employer Defined Benefit Pension Plan GASB 68 Valuation Report. So it's just that one file that you can use to update your current footnote disclosures. So for the cost-sharing plans, again, they're available on CalPERS website because they're issuing one for each of the risk pools. And you can see the title there, GASB 68, Accounting Valuation Prepared for Blank Risk Pool. So there's one for each. Then there's that separate report for the employer allocations. And what it has is an employer allocation by rate plan. There's a section for the miscellaneous and a section for the safety. It's all one total report, and you find your percentages, your entity. There are going to be multiple lines in that report for each entity because it's one for each of your rate plans. So at a minimum, most entities are going to have two, one for your classic and one for your PEPRA. But if you have other tiers, you'll have multiple lines, and you will be able to tell. The second column, I believe, is your employer ID, the number for your rate plan. So then you'll be able to match it up and figure out which plan is which for the allocation. Then they have a separate report, that report. Then they also have issued a GASB 68 guide for public agency cost sharing multiple employer defined benefit plans to tell you how to calculate it's a guide for how to calculate your amounts. There are a couple of very minor errors in that report, very minor, but we're hoping that CalPERS is going to make corrections to it soon just so there isn't confusion. But also in this report, this one here, on page, I think it's page 79 or 89, after all of the employer percentage allocations, there are footnotes to that report that also tell you how to calculate your amounts, which percentages to look to. And we're going to go over it a little bit in a minute here. So some other changes that CalPERS made this year is for both plans there are changes to the footnote disclosures. Starting with fiscal 16, there's now what CalPERS is calling a divorce from the funding versus the accounting, oh my goodness, what's it called? Discount rate. The discount rate, the important number. There's a divorce. So for funding, the discount rate is still going to be 7.5%. But for accounting reporting, or in the accounting valuations, it's 7.65%. The reason they've made that change is GASB 68 requires the discount rate to be gross of administrative expenses, and CalPERS rate of 7.5 is net of administrative expenses. So if you remember in last year's accounting valuations, in the discussion about the discount rate, there was some discussion about that, and CalPERS justifying that of why the net rate was used and that the difference was immaterial. But with the implementation of the the 15 accounting value, 15 measurement date, they are grossing it up and reporting it gross. So that's going to be a change in assumption that needs to be disclosed in the footnotes this year. So also, obviously, one of the obvious differences this year is your measurement date this year is now 15 rather than 14, June 30, 15. So I refer to it in the slides a lot in here. You'll see later on is MD 15, measurement date 2015. There will be disclosure of change in assumptions, and then finally, a very minor issue, but in the disclosure about the discount rate, there's the asset table for CalPERS investments specific to the pool or the Perf C, and that is there's some percentage allocation differences, so you want to update those in your footnote disclosures. Oops, sorry. So, and for the cost-sharing plans, there are 2 additional disclosures that you'll have to make this year, and we will talk about those as well in detail in a little bit. But those are the difference in actual contributions and the proportionate share of contributions, and also the change in proportion. That's going to be something new this year for your cost-sharing plans. And that's what we're going to go over next. So there are 2 deferred inflows or outflows, depending on how your plan falls, that are not provided by CalPERS. They provide you the tools to calculate it, but you have to actually make the calculation yourself. Because for the cost-sharing plans, as I talked about, that allocation schedule that CalPERS that gives you the percentage of fiduciary net position and the percentage of total pension liability, you calculate the difference to calculate your net pension liability. There are these other 2, they call them employer-specific deferred inflows and outflows, because that's plan as a whole, you calculate your numbers. This is employer-specific deferred inflows and outflows that you have to calculate this year. So the first is the difference in the actual contributions and the proportionate share of contributions. Some of this is going to get a little tedious, and hopefully in your slides, in your handouts, it'll be a little clearer, but hopefully just bear with me. So the difference in the actual contributions and proportionate share of contributions. Again, this is just for cost-sharing plans. If I can get a show of hands, how many of you have a cost-sharing plan or more? Okay, good. So it is the majority of you, so I'm going to keep rambling on about it because some of you may have an agent plan and a cost-sharing plan, so it's going to apply to you. So for the difference in actual contributions and proportionate share of contributions, you may or may not have calculated this amount last year. It is something that's an annual calculation that needs to be made each year. And it's taken by multiplying the total employer contributions to the plan for the respective risk pool, which I'll show you visually in a second, by the employer rate plan's fiduciary net position allocation percentage. So that comes out of that report that you're going to get off the CalPERS website. There's a percentage. Then the employer's and then you subtract, where's my little, there we go, and then you subtract the employer's actuarially determined contributions, or ADC. One important point, again, this is measurement date 2015. So the actuarially determined contributions that you're going to use are going to be your fiscal 15 contributions for this calculation, because you don't want to compare apples and oranges. So it's going to be your share of the pool as a whole contributions compared to your own contributions. And the difference between the two is a deferred inflow or outflow, depending on if the ending amount is a debit or credit. Okay, debits, I'm going to say it backward, I know I am. Debits are deferred outflows and credits are deferred inflows. Okay, I got it right. So so debits, if it's a debit, if your ending calculation it becomes a debit, it's a deferred outflow, and if it's a credit, it's a deferred inflow. And so that calculated balance is then amortized over the estimated average remaining service life, or EARSL, of the plan as a whole. So for measurement date 15, you'll see in the reports that that number is 3.8 years for the risk pools. And this is an annual calculation that you do each year for that year's measurement date, and then that amount is recorded on your statement of net positions, and then amortized over that amount until it's gone. So that's what we're going to talk when we get into deferred inflows in a little bit. There's going to be layers and amounts. You know, last year's amounts don't go away. They continue on and continue to be amortized. So now we're going to go over some visual of this so you can see it. This is out of the cost sharing plan. This is from the safety plan to give you just a visual of what it would look like. If you look at the safety plan pool accounting valuation, you'll find this page. It's the most important page because it tells you the pool as a whole. Again, not that you can see it on this screen, I'm sure, as a whole. But this line here, right here, contributions for the employer, $476 million. Those are total employer contributions for all participants in the safety pool for that year, for measurement date 15. Then if you went in that same report, the estimated average remaining service life for the pool is 3.8 years. So that's two pieces to the puzzle that you need. The next piece to the puzzle you need. Now, I created this excerpt since San Leandro is where we are sitting. I used them as an example. I pulled their percentages out of the from the employer allocation schedule on PERS website. And so they have two plans, and these are their allocation factors. They have the total pension liability allocation factor, the fiduciary net position allocation factor, and then deferred outflows and inflows. These are the same percentages as we go through. Again, it's going to get a little tedious, but the other examples throughout this rest of this presentation are all based on these percentages, just to let you know. If you want to check my math and make sure I did it right, you can always go back to these percentages here. So then we add them together. We add these together. And so again, this calculation that we're trying to do for the difference in actual contributions, you use the fiduciary net position percentage, so this number here. So then you take employer contributions for the plan as a total. You remember that $476 million number a couple slides ago. You multiply it by that 1,436,804 number to come up with 6.8 million. That's their proportionate share. Yes?
The employer contributions, that's irrelevant of which portion the employer and the employer pay, correct?
Yes. So for CalPERS purposes, employer contribution, they don't care if your employee is sharing or the employer is sharing, either direction. For CalPERS, it's going to be the employer percentage, because if you think about those your reports you issue through MyCalPERS, it's the employer share. It doesn't have to do whether you have any sharing between the two. PERS, if you report it as an employer contribution, that's what it is. And so that's, yes, if there's any sharing, it doesn't matter. So for the number, when you come down to your per GL number, which is right, where is it hiding? Here. Oh, no, there. Actuarially determined contributions per GL, that's going to be your employer contributions, exclusive of sharing. Okay. Good question. So you take this calculation, you compare it to what your actual contributions, again, remember this is 2015's contributions because you want to compare it to the same basis. 2015 measurement date, 2015 contributions, come up with the difference. And these differences are always calculated as the beginning of the year. Even though it's a number for the full year, it's the number at the beginning of the year. You amortize it this first year of 16 because we're doing a measurement date of 15, so you have amortization for fiscal 16. So you have the ending balance at June 30, 16, which is this $2 million number. Okay? For this particular one, it's no, because you're calculating it as the beginning. You're calculating this number, for this 6,000,008 is calculated as of July 1/15, because you're doing your fiscal 15 contribution proportion. And so then you amortize it for the first year.
Going forward, after 4 years, we will always have 4 layers of amortization.
You would always, exactly, like this one will last, this will last for 2.8 more years. So you're going to amortize it over that remaining service life. Yes, so it'd be.
All of these separately.
You have to try, that's the key. You're going to now be responsible for tracking these amounts individually yourself, because PERS is just giving you the tools, and that's why this second year becomes important, because they're not giving you all of the numbers you need. You need to do these calculations and track each them in layers or columns or something, so you can see that this number's going to continue on. It doesn't go away next year. It now continues to be amortized until it's done. Yes, that's the confusing part. You thought year 1 was hard. Now you have to get year 2, and you have to do all this extra work yourself. Forever, exactly. And that's the next number, which is the change in proportion. For the cost sharing, PERS did give you this number this last year. They're not giving it to you this year because you have to calculate it yourself. Because again, that's why they call it the employer-specific numbers. They're only giving you all of the pool information, not employer-specific amounts. So the next number is the change, calculating the change in proportion. Same logic, it's just, again, it's just a mathematical calculation. So the change in proportion, because this year, I'm just going to use flat numbers. This year, say your cost sharing plan is 5, I'm going to say %, even though that would be huge in a cost sharing, in the PERS pools, it's going to be something much smaller than that. But if your share is 5% this year, but last year, because of the different number of participants, your share last year was 4%. Well, that means if nothing changed, your net pension liability doesn't go up just because your share increased. Now you share in 5%. So that's considered a change in proportion, because really your particular amount, that doesn't mean the net assets and liabilities also went up and down. So that change in proportion of the 1%, you have to calculate that dollar amount associated with it. And then again, GASB loves deferred inflows and outflows. You're going to calculate it and then record the difference as a deferred inflow or outflow as applicable, whether the calculation becomes a debit or a credit. So that number is based on, so you have to use your share. If you remember again back to that San Leandro example, so using those percentages and applying them to the safety plan, again, continuing on with the safety plan example, the proportionate share of the fiduciary net position of the plan, you calculate that first, that's here, but this is this is the change in proportion. So you're using measurement date 2014, the beginning of that. I'm going to flip back for a second here. Oh, I'm pointing it to the wrong place. Let me go here. Nope, there. Oh, too far. This one. For change in proportion, we're talking about the change in proportion from 14 to 15 measurement date. So this calculation, you're actually going to use these beginning numbers, the beginning of the year numbers. These will agree to last year's, if you were to pull out last year's accounting valuation, this would agree to last year's pooled accounting valuation numbers. I checked, they do agree. So I know you just couldn't wait to know that answer, right? So you're going to use these to calculate it. So again, you're calculating the beginning of your measurement period. What was your proportionate share? If you were to know now, or then I should say, what your proportion would be next year, that's what you apply to it. So you take your 2015 proportions or percentages and multiply them by the beginning of the year numbers to come up with what would your liability have been. So that's why I don't know how to, I know there's a way to skip down quickly, but I don't know how. Then you take these numbers, your percentages at the end of the year. Hello. And then calculate what your fiduciary net position would be, what your total pension liability would be, and come up with, in this example, City of San Leandro's net pension liability, notice it's a credit, would have been $52 million using this year's measurement period percentages or shares. But what was reported at measurement date 2014, as of June 30, 2014, was only $48 million. So something changed. The dollars, the percentages, the dollars, the math changed. So now they have a change in proportion. Change in proportion at the beginning of the year to calculate and report. And again, it's a deferred inflow or an outflow. This example is a debit, and excuse me? Yes, debit. No, it is right, debit. So it's a deferred inflow. Yes, thank you. You were paying attention. See, I always get it backward and you were on it. I didn't do that on purpose, all right? So I couldn't be that quick. Okay, so then you amortize it. You do 1 year of amortization, and so your ending balance at June 30, 2016 in the financial statements would be $3 million. Another one to calculate, and this is, again, an annual. This number will stay until it's fully amortized at the end. I know this is a heavy, heavy topic. This is your June 30, 2016 balance, yes, in this example.
So on the slide 2, slide before, what was that the next year?
That's the change in, that's the difference in actual contributions versus proportionate share of contributions. So this is your June 30, 16 balance for that one. So these are the two separate calculations, you have to calculate for the cost-sharing plans. I'm realizing that I didn't even include it in this presentation because in my mind I was just thinking of all the new things that you have to do. For the cost-sharing plans, you have to calculate all of your amounts. You have to calculate your net pension liability. You have to calculate deferred inflows and outflows using the numbers that are coming from CalPERS. But then, unlike the agent plans, that's why I focused on this, because you have to do 2 more calculations that no one else has, than any of the agent plans have to do. You have to do these 2 more calculations and calculate it and amortize it yourself. You're not going to be able to use the information or the amortization schedules from PERS, because PERS will give you the amortization schedules for the deferred inflows and outflows, and you can calculate your proportion and go from there. But for these, you have to do the math yourself and make sure you're calculating it correctly. Okay. So in addition, so that just changed the calculation and proportion for the net pension liability. Then you also, I know you're so excited about it, have to calculate your change in proportion for deferred inflows and outflows, excluding any employer-specific amounts. Because if you were to pull last year's accounting valuation from PERS for your cost-sharing plan, they gave you your own report, so you had your proportion. That report included the change in proportion. That's considered an employer-specific amount, so you have to pull that out. Because if you look at last year's report, if you look at last year's accounting valuation and go to this and find this schedule in there, notice it does not include any employer-specific amounts. It only includes the plan-specific amounts. So this is what this schedule is what you're going to use to calculate your deferred inflows and outflows. And so it's the same math as the change in net pension liability. You take this year's percentages for the deferred inflows and outflows, but apply it to the beginning balance. Clear as mud? And just so you know, because you're Maze clients, don't worry, we will help you. We will give you tools to do this, but you still have to understand it. They're your financials. We have to be able to audit the information, so we're going to give you the tools, but you do have to do it. You have to do the work, prepare the journal entries, get it recorded in the general ledger, and then we'll audit it. But we'll give you some tools and information to help you along the way, but we want to make sure you understand the basics and the information. So using those numbers there in the for the deferred outflows, sorry, I'm getting distracted by my own notes. That information was on, this was on schedule. What is that? Oh, no, different one, sorry. Okay, so using those percentages, you use the deferred inflow or outflow percentage, again, going back to that San Leandro table, if you were to take that last column for the deferred inflows and outflow schedules, multiply by the beginning balance, then you come what was in the accounting valuation last year. Again, we're using good old San Leandro, so you can look to their last year's financial statements to look at this information. So their proportionate share of deferred outflows at the beginning of the measurement period would have been $7.4 million using the current year percentages. Last year's general ledger had $14.6 million. Then you have the change, amortize it for 1 year. Notice it's always over that 3.8% because of all the deferred inflows and outflows, they're all amortized over the same basis except for one, the investment. We'll talk about it in a minute. Investment change is amortized over 5 flat years. Everything else is the estimated average remaining service life. And so then their June 30, 2016 amount for this part of the change will be $5.2 million. You add that to the change related to the net pension liability, and they have a huge deferred outflow, debit, of $8.2 million to record. Okay? So, as we talked about, these amounts last year's amounts for the change in proportion for your cost-sharing plans still out there, but PERS isn't giving it to you. So you need to go to last year's accounting valuation and go to Schedule B-1, and that's where that's where the amortization of that amount, there's an amortization schedule for that amount in there. And so then you know what amount you need to record in the general ledger this year. And so again, this is something that you're going to do every year. Next year when the new measurement date 16 comes out, then you're going to do these calculations again and have a new dollar amount that you're going to amortize or record and amortize. Any questions before I breeze on? Don't worry, it doesn't get any easier as we move on to the next slides. Okay? Okay, so something else that, and this is not, so this, what I've gone through so far, that CalPERS guide, you do want to take a look at it. Like we said, we're going to give you some tools as well, but that CalPERS guide does walk you through some examples on how to do this as well. But one part that it doesn't have yet, we're hoping they're going to add it, is the sensitivity schedule. You know this, you have to have that disclosure of the sensitivity of the net pension liability, the sensitivity in relation to the discount rate, whether it's one, so this year the discount rate's 765 as we talked about. So what if it was 665 versus 865 and how the net pension liability is affected? So the accounting valuation will have it for the plan as a whole, but you need to disclose it for your proportionate share or your, well, if your agent plans, it'll already be in your agent plan. For the cost sharing, you have to disclose your proportionate share of it. So there's actually a lovely calculation that you have to do, because they don't give you the information to figure out. You can't just take your share because you don't know what the impact is, how it impacts on the plus and minus. Obviously the middle you can figure out, but the plus and minus of the discount rate, the increase and the decrease. So what you have to do is you have to take that net pension liability they've got there, so that matches the prior slide, hopefully. Yes, it does. Then you add back the plan's net position. So if you were to flip all the way back in your slides to page, slide 81. So slide 81, the plan's fiduciary net position is $14 billion. Right? Billion, getting my zeros right? Yes, $14 billion. You can see it's the same all the way across. You add back the plan assets or net position to come up with a total pension liability. Then you use your total pension liability percentage, again, from that allocation report. We're using San Leandro as the example. So remember, none of your numbers, you know, we're auditors, we're going to notice if you use San Leandro's numbers. So we should only see these in the slides, not in all of your financial statements, okay? We're not giving you that answer, okay? So these percentages, okay? That'd be funny if all of our clients had 14,28801, you know? It's like, it's magic. So then you calculate the your total pension liability proportion. Then you take your percentage of this one's complex, you thought the other ones were hard. Then you take your percentage of the fiduciary net position, so that's your percentage of this number, okay, again, San Leandro, to come up with fiduciary net position proportion in dollars. And then you recalculate the net pension liability. So now you're taking the total pension liability minus the proportionate share of the fiduciary net position to come up with your particular sensitivity schedule. Woohoo! Yay! This is year 2, and you get to do this every year from now on. So, any questions on that?
You're going to be handing out an Excel sheet, right?
That's our hope. And also, I'm going to talk about it at the end, but also, you know, I'm sure most of you are familiar with the CCMA white paper. That group had talked about doing a new white paper this year for things like this, but instead we're just going to do a Q&A because we want to get it out quickly rather than the length of time it would take to do a full new white paper. But that's also something we've talked about, is maybe through that group doing an Excel spreadsheet as well. Yes. Or maybe one of you can get CalPERS schedules. You know, they might share their Excel if you don't want to wait, but we're working on that. Yes. We're just worried about, you know, you have one math problem that goes backward. It's that debit and credit thing. You got to get the debits and credits, deferred inflows and outflows right, you know. Otherwise your auditors will yell at you, right? Okay, so talking as if you haven't heard about deferred inflows and outflows enough today, we're going to talk about them again. So, Deferred outflows and inflows, so you have 4 things to worry about. You have amortization, because especially, if you have any standalone plans, you have to make sure your actuary may or may not give you the information you need. You may have to do the amortization yourself. How do you amortize it? What's the basis? What do you do each year? Something else you have to do, use the actuary amounts, of course, and then test schedules separately. So you're getting the information for CalPERS. If you have an agent plan, you want to check their math. Make sure that the amortization schedule works. There are, some of it's just rounding usually. There's the dollar problems you have. So you want to just make sure you're making those corrections consistently to make sure that the math works. Then layers. By layers, I mean those years. You're going to have the prior year deferred inflows and outflows don't go away. They are amortized until they're gone. Those are the things that you have to calculate and track. And in CalPERS, in the agent plans, they're in there. They're in the back. They've got all the schedules you need to have last year's balances and show how they amortize out to 0, and you can see the layers and what your ending balance should be. For the cost sharing, it's in there as well, but again, it's at the plan as a whole, not just specific to your plan. So the first to worry about is your differences between expected and actual experience. I'm not going to read these. Thank God. I'm sure you're happy about that. So it's just about the basics of these schedules is what is it, and then what's the basis for the amortization. So for differences between expected and actual experience, it is amortized over that EARSL number. Again, for your plan. So for the pools, it's 3.8 years. It's the average remaining service life for the plan as a whole. So even though you have miscellaneous and safety, it's all part of PERF C, as they call it, Public Employee Retirement Fund C. So that's why if you were to have 2 accounting valuations side by side, one for the safety and one for the miscellaneous and the cost sharing, it's the same as the EARSL. Well, it's because they are together one pool. Miscellaneous and safety are really just 2 rate plans within one pool. Then the unamortized balances, so those layers, each year's amount is either a deferred inflow or outflow, right? The year it's calculated, it is what it is. It's a debit or a credit. And it will always be reported as a debit or a credit, deferred inflow or outflow. Any new layers that you have, subsequent years, that year's layer may be the opposite direction. They're reported gross. If one started out as a deferred inflow, it will always be a deferred inflow. And the new layer will be whatever it was. So that's why you may have, the columns. If you think of the deferred inflow and outflow table as being in columns, you've got the 2 together, they will be gross. So that's really what these slides are about, is whether they're reported gross or net, because they're all reported gross except for one. So change in assumptions, same basis of amortization again, EARSL, and reported gross. That's the years or the layers are reported gross. Difference between projected and actual earnings on pension plan investments. That is the one that is amortized over a 5-year closed period. And any layers are reported. This is the only one that's reported net. Layers over the years are reported net. So if you were to look at the CalPERS schedule, in the schedule of deferred inflows and outflows on their table, they actually report it gross. So you should add them to net them together and then report the net amount. Okay? So here's the example. Oh, I forgot I had the slide. Sorry, I should have looked ahead. So this is the example out of the safety cost sharing plan again. So in the safety, you can see they've got the change in assumptions, difference between expected and actual experience, and then the net difference of actual earning on pension plan investments. The reason they've got, you notice that the other 2 only have one number. Excuse me, because if you remember back to the accounting valuations for measurement date 14, those other amounts were not populated because that was year 1. The only amount that had a population was the net investment, deferred inflow or outflow. So now they've got 2 layers, and they reported them gross in this table. But for your financial statement reporting, it should be reported net. Does that make sense? Okay. So again, for the just specific to the cost sharing plans, you've got the difference between the change in proportionate share. That's just for the cost sharing plans. That is also reported on the EARSL. Oh, I forgot. This one's reported net as well. Sorry. I said the investments was the only one that was gross. This one is also reported net. So any prior year and current year balances are added together, and if the debits exceed the credits, then it's reported as a deferred inflow. Outflow. Shoot, gosh, one day I'll get it. It's a debit, it's an outflow. Yes. Okay, then the last one is the difference in the actual contributions and proportionate share of contributions, and this one is also reported net. So those cost-sharing amounts are all reported net, those special ones. So this next part, some of you, it might not be a problem for you. You know, that when we started this original presentation, it was for our auditors. We did some internal training for this information. And so this was just kind of a handy-dandy. Again, you probably can't read it in the back, I'm sure. I'll make a test later to tell me what that number is for you in the back corner. So this is just an example disclosure. This is a common one that you'll see in the financial statements, because you're, as part of the, it's not just from 68, just from pension disclosures that even predates, what was that for? God, I can't remember the number. What was the original one? 25 and 27. You're required to disclose the attributes of your plan. What are the benefits that each group can get? You can go down to really detailed information into the different tiers, how many tiers you have, or some clients disclose just a range of percentages for the different benefits. You can be as detailed or as summarized as you would like. So, in case any of you struggle to find the information or don't have the data to figure out where to get it in the financial statements, we call it the landscape page in the actuarial valuation. That includes the list of all rate tiers plus PEPRA. You know, that first year, the PEPRA tiers were not in the early actuarial evaluations. They didn't start until, is it 14 that PEPRA's listed? Does anyone know? No one knows. No one's looked for their 14 valuations. So if it's not, if you don't see the PEPRA tier included, then of course you have to go get your PEPRA information, your contribution information. And so, however, that landscape page, some of the information, they might not be, it's going to list all of your plans, even some that are inactive. You may have some people that retire, you know, retirees, that there may be one or two people left in that tier, and so it might not be an active tier. So that's what you want to talk to. You know, if you don't know specifically, contact HR to find out which tiers are your active tiers. In this example from a client, there were 4 different tiers, and you can see they've got, not that you can see from there, but there's a 2.0 at 55, 2.7 at 55, 2.0 at 62, PEPRA, and a 2.0 at 55. So they've got 4 potential tiers that may or may not all be active. So that's what you can use as your start to figure out which tiers, which information needs to be disclosed in your financials. Then also in the actuarial valuation, there's the percent, you know, that shows the rates or the plan formulas for each, and that lining up with that last example, we put red boxes around the ones that are active, and you can see, like, so your range of benefits for the 2.5 at 55. I'm speaking to a group that definitely knows these percentages better than us, so you know that the top and the bottom is usually what's disclosed when it comes to the rate information. Then that was a miscellaneous example. There's a safety example, and that schedule shows you your employee contribution rates, but of course this doesn't factor in any sharing arrangements you may have, so then that would be an additional disclosure that you should make. Okay? So next we're going to go into the footnote disclosures. So one of the first important points here is making sure, because your footnotes last year, you know, it was year 1. We were all learning in year 1. In year 2, we need to tighten it up a little bit, because there might have been some distinctions that need to be made between what's a plan versus plans. So just because you have various tiers within your particular retirement structure, that's still all part of one plan. If you could have 10 different tiers, depending on, you know, what your entity has done over the years, but it's all still participating in one agent plan or one cost-sharing plan. So you want to make sure that those that distinction is tightened up a little bit this year, because I think in a lot of the disclosures last year, people were identifying the tiers as plans, and it's not. Those are just benefit tiers or rate plans within the plan itself. Make sense? Okay. And so as I alluded to earlier, that even is the same when it comes to miscellaneous and safety that participates in the cost sharing. Really, that's just one plan. If you have two cost-sharing plans, you participate in both miscellaneous and safety cost-sharing for your entity, technically you have one plan with two rate plans within that, that's actually something new to me. You just don't see that nuance of it all being part of Perf C. Perf C is the plan. Okay. So what are your required disclosures? So the required disclosures, one of the required disclosures, is pension expense. Well, how do you calculate pension expense? How do you get that number? This is an easy mathematical way to get there, hopefully, because it's you got to take your fund level expenses, because you remember your fund level expenses for most of you with a June 30 year end. In the financial statements, those are going to be, in the statement of net position, those are going to be recorded as a deferred outflow because they are contributions after the measurement date if you have a June 30 year end. So they're not actually in expense at the entity-wide. They reduce, in the following year, they reduce net pension liability. But how to calculate this, how to get to pension expense, is you start with those fund level expenses, then you add in your change in the net pension liability, your change in your deferred inflows and outflows, because those all flow through pension expense, and your change in deferred inflows. Then the sum of all of that becomes your pension expense, and that's the amount that's reported in your footnote disclosure. Okay? The disclosure is pretty easy. For the year ended blank, the entity recognized pension expense of blank. That's a pretty easy one. Okay. So there was an error in the terminology in the white paper last year. Hopefully, for some of we didn't catch it quite in time, so some of your early financial statements may have gone out with the inappropriate or incorrect wording, but that's something that can definitely be cleaned up this year. It's not something that's going to, if you're going for a CAFR award, it wasn't something that would actually kick the CAFR out. You may have gotten a comment on it if they noticed. The white paper said, for the year ended June 30, 2015, contributions recognized as part of pension expense were blank. That's an when we talk about pension expense, your current year contributions were not, they were after the measurement date, so they were not part of pension expense. And any contributions, because now you've implemented GASB 68, any contributions don't actually go toward it, they affect the net pension liability. So that's why the revised or corrected disclosure is just that for the year ended blank, the entity's contributions to the plan, because you are required to disclose what your contributions for the current year were, and so that's different than anything to do with pension expense. So in this year, it'd be your fiscal year 16 contributions were blank. It's pretty easy to figure out if you have a June 30 year end, because it should equal your deferred outflow, right? Okay. In the required supplementary information, this is another thing to make sure that your required supplementary information was disclosing the correct information, because it was in the white paper, but it wasn't quite, you kind of had to figure out a little piece of it. So the required schedules are the schedule of changes in net pension liability and related ratios. That's for the agent plans. That one is as of the measurement date. So that's why you would use the information out of the CalPERS accounting valuation. Then for the cost-sharing plans, it's the schedule of proportionate share of the net pension liability, and that's, again, as of the measurement date. Then the other schedule, the schedule of contributions, you have to have that for both agent or cost-sharing. The schedule of contributions is for the fiscal year, not to do with the measurement date. So it should be, this year it should have fiscal 15 and your fiscal 16. Because remember, with this RSI, you're going to start adding data for each year up until there are 10 years of information. Okay. And you don't replace the prior year information. Then if there are any changes in assumptions, those need to be disclosed in the required supplementary information. And this year there is a change in assumption related to the discount rate. So you will have to have a disclosure for that. And in the CalPERS reports where they give you the footnote information, there is a footnote disclosure for changes in assumptions, so you don't have to make it up. You can use the data provided by, or the wording provided by CalPERS. So one other little nuance, you notice in the schedule of changes of net pension liability and related ratios in the accounting valuations, CalPERS includes this disclosure and discussion about, it's very generic and it talks about golden handshakes, and I had a client ask, do we have to talk about that? Our plan, we don't have any golden handshakes. Well, it's just CalPERS using a boilerplate template, and you can definitely modify the footnote disclosures to make sure that the footnotes to the RSI to make sure that they are specific to your plan and what your particulars are. So it's not a problem. This is the boilerplate that's at the bottom of the schedule for last year. So on the schedule of contributions for the agent plan, it includes the actuarially determined contributions, the actual contributions, and the difference. If you're in CalPERS, there can't be a difference, right? You're required to make the contributions, so there won't be a difference, but you still have to show this calculation. Then covered employee payroll, we'll go over in a second. We've already alluded to it already. And the contribution as a percentage of covered employee payroll. Methods and assumptions, and for CalPERS, the actuarial assumption information is going to be from 3 years prior, because that's when which actuarial valuation is used to set the rates for that particular measurement period. And then the schedule of contributions for the cost-sharing plan includes the actuarially determined contributions, much simpler than the prior one. Actual contributions, any difference, and the covered employee payroll. So let's talk about covered employee payroll. We talked about it earlier when we did the Q&A on GASB 82. So covered employee payroll, that's what under GASB 68 you are required to disclose, covered employee payroll. So that is total payroll for all employees that participate in the pension plan. All payroll, not just pensionable payroll. Covered payroll, which is the term we're more familiar with, that's what was required to be disclosed in the past, prior to 68. Covered payroll is just your pensionable payroll. So the information, if you were to look at your accounting valuation for measurement date 2015, PERS has put they have a footnote that says, that refers to GASB 82 and says that their information that they're providing you is only covered payroll. If you want to not early implement 82, then you need to disclose your covered employee payroll. One option is to early implement Statement 82, change it to covered payroll, and move on. But there, if you remember back when Cody did the 82 discussion, there are 3 components to GASB 82, so you have to make sure you can't pick and choose. Like if you want to early implement 82, you have to make sure that you implement all 3 aspects to it. The one is that there are no deviations from accounting actuarial standards of practice. What was the third one? There's the covered employee payroll. Oh, the employer-paid employee contributions. If you're treating those as compensation, then you're okay. But you can't pick and choose and just implement this part of it. But I'm suggesting to clients, because it does seem to be a pretty low impact GASB, that consider early implementing it, and then you don't have to worry about it in the future. But you have to remember also in the schedules that PERS is providing to you for that covered payroll number, they are not giving you your actual covered payroll for, like if we look at measurement date 15 and it's got that 15 schedule, because if you read the fine print of the accounting valuation, they're projecting what that payroll amount is. So you want to consider also just including your own actual covered payroll in the RSI, so that it is a little more good reader information for what your actual covered payroll is. Okay. So this part is just a reminder. So while we're in this phase where you have GASB Statement 68 and we're not quite to the implementation of GASB 75, the OPEB one that I know you all can't wait for, there's a difference on the statement of net position to make sure you still refer to net pension liability, that's your NPL, and then the net OPEB one is not a liability, it is still a net OPEB obligation. And remember, your net pension obligation is gone. That terminology, that was gone with the implementation of Statement 68. But we have seen a couple of CAFRs where the terminology gets a little mixed up on changing OPEB to a net pension liability as well, and it's not. It's still an obligation. A little difference, but that will get you a CAFR GFOA comment if you're going for a CAFR award. Okay. Journal entries. Journal entries can get even more tedious than all the lovely stuff that I went over here, but this is just a good sample for you to look at. again, when you're tired and you can't go to sleep. So the data to be recorded can be segregated between actuarially calculated amounts and employer calculated amounts. So I'm just kind of going over the how-to, but I'm not going to go into the details of the journal entry. So this gives you a good summary, again, better in your handout than on the screen, but just to tell you what the different components of your statement of net position and where you get the information here, the source, and then any additional notes on whether they're reported gross or net when your debits and credits are reported gross or net. So you can see your change of assumption is from your actuary, difference between expected and actual experience actuarially determined, difference in contributions to proportionate share, employer calculated, change in proportion, employer calculated, difference between earnings and investments actuarially, and then contributions after the measurement date is employer calculated and NPL actuarially determined. Again, for your cost sharing plans, even though many of these say actuarially determined, you have to do the math this year, but PERS gives you the tools to do it. Then you can work through this journal entry as you I'm sure you all want to do because you loved doing the journal entries last year. Wasn't it fun? Especially those of you that had lots of enterprise funds and internal service funds. Nothing like that allocation. You got to do it again every year. So this was just an example. You can look at it. This one consolidates everything as one. Then of course, if you have that allocation between governmental activities and business type activities, you have to do the allocation between two. What we found, most clients used payroll as a method or as a base for determining the allocation. Did anyone use something other than payroll? Okay, so it was the most common. Okay, good. You know, because of course you can use anything as long as it's reasonable and makes sense from year to year. So then this is the sample journal entry. It does balance, thank goodness. So that you can work through the two tabs to kind of figure out how it works. And then some resources for you. So good resources, of course, GASB's 68 and 71 on the GASB website. Then CalPERS has a GASB 68 page. This is the link here. Hopefully most of you are familiar with it because that's where you're going to pull down your reports, like even if you have your agent plan report, you have to pull the footnotes down from CalPERS website. That's where all the cost sharing reports are located, and that CalPERS guide. I put another link specific to the guide here. And then the CCMA white paper. This is where it is. I gave you the link to the top of the white papers because that's where, when the Q&A is issued, the update will be at this same location as well. All right. Any questions? None? Yay. All right. Great. Thank you.